first monetary policy under the new governor has been announced, and it was quite a seminal policy in terms of a certain change in tone, in stance and in action that it brought about. The key takeaways: one, of course, there has been a cut in rates, and two, there has been a change in stance. Basically, coming to neutral would mean that the chances of a rate cut are higher, because in the previous calibrated tightening stance, rate cuts were off the table. Now they are on the table. The more important takeaway is the inflation forecast for 2019 have been cut by a good 60 to 80 basis points from an already lowered interest rate projection in the previous policy. Now for the entire 2019, the highest inflation rate is 3.9%, below the Monetary Policy Committee's mandated 4% CPI. A fourth takeaway is that there has been a much more recognition that growth needs support. There were various references both in the policy statement and in the press conference thereafter to foster and bolster private capex, which has not picked up at all. And finally, there has been a bit of munificence, if you please, a bit of SOPs for the NBFC sector. A large part of the risk weight has been reduced for a large number of NBFCs, and that could reduce the cost of borrowing for those NBFCs where banks don't have an asset quality doubt. Those seem to be the key takeaways, but to parse it further and to tell us how things may pan out for the next 1, 2 or 3 quarters are a panel of very important and eminent experts. I have with me Mr. Dinesh Khara, Managing Director, State Bank of India; Sajid Chinoy, the Chief Economist from JP Morgan; Manish Wadhawan, the Head of Global Markets at HSBC India; and Mr. V.S. Rangan, the Head of Finance at HDFC, the mortgage company. Gentlemen, thank you very much for joining me. Sajid, let me start with you. A credit policy, a monetary policy which changes stance and gives a rate cut must be an economist's pleasure. What are the key takeaways for you?
So Lata, we're not particularly surprised. Our view was they would change their stance and cut rates today. And I think what you got from the MPC today was a reinforcement of what we got in October, which is that monetary policy is going to be conditioned on the legislated mandate, which is that it needs to be around 4%. And all these other risks that we talk about, which are meaningful, whether they're fiscal risks or currency risks or oil risks, ultimately have to manifest themselves in current inflation or forecasted inflation for the MPC to respond. I think that's a very important takeaway. Now, as you pointed out, there's been the economy the outlook has changed quite dramatically in the last 6 months. Oil prices have collapsed and food prices are exceptionally benign. What that does is the outlook for inflation does remain benign. The RBI, as you said, has slashed its forecast, to their credit, marking to market regularly nowadays, by another 70 basis points, and inflation is going to remain below 4% for the foreseeable future. So I don't rule out some modest easing, maybe another rate cut in the next quarter. I think I'll end by saying the key in terms of the monetary policy outlook is a year from now, given this wide divergence between headline and core, will headline converge to core or will core converge to headline? The answer to that question will determine how much space, if any, the MPC has. For what it's worth, our research shows that ultimately it's headline that converges to core. So we think as the year goes on, the space for any monetary easing will be foreclosed. Finally, I'm not so worried about growth. I think if you look at the stickiness of core inflation, it tells us at least that output gaps are virtually closing. So I'm a little bit more sanguine in terms of growth prospects and where the output gap is.
Well, you can argue that even the RBI's, while the language may be worrying about private capex or rural distress, a 7.4% forecast for next year can hardly be considered, worries over growth. It's quite clearly not a level of growth where most countries would give monetary and fiscal stimulus. But that's a matter I'll come to you in a bit. Let me ask the bond yields expert what he has made of all the statements on open market operations. Manish, putting together this outlook on inflation that Sajid explained and that you could get from the inflation projections of the Monetary Policy Committee and the statements made on OMO, what is your sense? Do you think OMOs will continue?
I think, Lata, on the first part, definitely a positive surprise for markets, because I think 90% of people had expected a stance change, but a rate cut is an icing on the cake today. Bond yields have already reacted around 5 to 7 basis points in the long end, and the short end has gone down by something like 10 basis points. And that is the outcome of what you are saying, that the maximum inflation during the current calendar year is not more than 5 or not more than 4. It's up to 3.9 what they're talking about. So I think, first of all, an expectation of a rate cut further in April is still there in this, and that is why markets are pricing at the short end. Second thing, on the OMO, it's a bit, I would say, not so straightforward, because it said that we will maintain liquidity as per the requirements. It clearly, I think the hint is towards that if the FX intervention is not very large and the liquidity remains neutral, plus minus 50,000, what we talk about, then the OMOs could be slowed down. So I think there was no commitment on OMOs for beyond February or for the next year. The only commitment was we will maintain the liquidity on a comfortable side, and that is what I think market is factoring on at this moment. So what you can expect in markets is short end, the curves to steepen more, a bit more, and then market stabilizing as per demand and supply.
Yeah. So what does that mean in terms of the longer term borrowing price? The cost of money for, what will be the yield on the 10-year? Do you expect it to come down towards, say, 7.3 or something?
Yeah,
as it factors in a rate cut, say, when the next inflation number comes?
Yeah,
or do you think it remains stuck at the current levels?
So it is quite possible that you might see a range now, which is around 7.25 to 7.5 on the new 10-year bond till March end, and then we get into the borrowing program of April, and then we see what happens in the policy. I think till policy, you could see some drift down in yields even further, because there are OMOs lined up in February, and the demand supply looks quite benign as of now for the current fiscal year.
7.5 on the 10-year would actually mean yields are rising. You will expect yields to rise.
I said 7.25 to 7.5. It's a trading range. It's an outcome which is quite binary, because after February the OMO stop, then the genuine bond demand supply will take over. Yeah. And at that point of time, you could see an overreaction on the other side also. Okay,
but let me come to Mr. Rangan there. Mr. Rangan, you got the impression that OMOs will stop. How are you looking at the cost of money in the wholesale market?
No, I think the rate cut on by the RBI, coupled with the forecast on the inflation, it's obviously directionally I would believe that the rates would be cheaper going into the closing of this year, and as it was discussed that the GSEC would probably be in the range bound of 7.25 to 7.5, and I think the next year's full budget and the borrowing program would obviously determine the course of action for the next year. But for the time being, as we get into this quarter and by end of this year, I would believe that the wholesale rate should soften from the current levels. I mean, it's a guess as to what could be the quantum, but somewhere between, I would expect 15, 20, 25 basis points is a rare possibility.
Okay, no, it may soften at the GSEC level, but does it soften at a CP level, Mr. Rangan? Because there are other problems that the debt market has.
I would believe so. I would believe.
Okay.
Yeah, I would believe that it has softened. If you look at the levels which were in September and now, it has actually softened. So, and I would, my impression would be that it would soften based on the current developments in the policy and this thing. It should soften a bit more. The levels could be discussed, could be the basis for discussion, but broadly I would think that directionally it will soften from here.
Couple of bankers I spoke with after the policy said that lately MCLRs have actually been crawling up. We have seen them rising by 5 basis points here and there. These bankers said that they may see the rise in MCLR stopping, but none of them thought that they have the elbow room to cut deposit rates or, for that matter, lending rates. What would your position be, Mr. Khara? Do you think lending, or say working capital lending or shorter term lending, at least say 3-year term loans, can come at a cheaper rate for some companies that you lend to?
See, when it comes to deciding the benchmark rate, benchmark rate, or for that matter the MCLR. MCLR, as I will again mention the same thing. Of course, it's a function of multiple things. The cost of credit which we have, that has got a component of if at all NPAs are higher, then provisions will be higher. It will have an impact on the cost of credit, which is required to support the credit activity. So that's the reason MCLR, whether it will come down or it will not come down, apart from many other factors, repo rate is one of the components. And as I was mentioning that, much of it will depend upon the book of the bank, what kind of provisions they are required to make. So all those variables are there which have got an impact on the MCLRs.
All right. So more generally, do you see anything in this policy and its projections, its tone, that gives you the impression that credit growth will be better off this year, Mr. Khara, over the next 2 quarters?
Yeah, I think one, of course, the policy has very clearly articulated, the concerns for the growth and the benign nature of inflation, and how the inflation is expected to be going forward for about a year or so. So it has very clearly articulated those thoughts, and I would say that the policy is quite balanced when it comes to addressing the inflation concerns, inflation expectation concerns, and also the growth concerns of the economy. The policy has come out very clearly in terms of the impact of the global growth and its impact of the global growth on the Indian economy. That also is a very positive way of looking at things, and it so appears that while the MPC has taken various this particular decision, they have kept these particular factors in mind while coming to this particular decision of cutting the rate and also changing the stance to neutral.
All right. Well, let me ask Mr. Rangan, given everything, do you think the cost of money for a company like yours falls now? Over the next 2 quarters, will it be cheaper?
So, Lata, the point is that you raised this issue about the risk weight being available, the change in the risk weight, whether it will have an impact on the pricing. I just wanted to clarify that what has actually been changed in this policy or intended to be changed in this policy is about the core of the NBFCs which were in the asset finance and infrastructure. They were already governed by the rating methodology as far as the risk weighting for the banks is concerned. What is getting included in the current scheme of things, the proposed scheme of things, will be possibly the loan companies, the companies which basically lend for various purposes and not necessarily in the asset finance category. So that section of NBFCs will get included along with the existing asset finance and the infrastructure financing companies. As far as the housing finance companies are concerned, we were always, the risk weights were always based on the rating as far as the banks were concerned. So there is no change in the methodology of capital allocation for the banks vis-a-vis the housing finance companies is concerned. They were always following this norm for the housing finance companies. So from the point of view, in terms of what you are trying to ask about the interest rate, whether it will lead to a reduction in the interest rate by the lender, I think I would tend to agree that it's a question of it's more about the generality of the rates. If the overall rate system is coming down, it will be, I don't think so specifically on the basis of this risk weight change. It's not going to change because it's already there in the system as far as housing finance companies are concerned and also some of the NBFCs are concerned.
Fair point. Sajid, are these projections similar to yours? Are you looking at inflation coming out as benign as under 3.9% for all of calendar 2019?
Well, I think 2019 is a year of two halves, Lata. The first 6 months, our forecasts are very similar to what the RBI has. Food prices remain very benign, and the fact is oil is still in the low 60s. And given the weight of food, we also look at an average of CPI in the first 6 months of 3.5 or below. What happens in the second half, I think, is a function of various factors. One is what will eventually the stance of fiscal policy be. This year we have a full budget in July. We're focusing very much on the consolidated public sector borrowing requirement. If that increases against this year and there's a positive fiscal impulse, that will have an implication for inflation projections down the line. And the second point that I made earlier, which is a lot depends on where you think output gaps are, and therefore whether headline converges to core or core converges to headline, where of the view headline converges to core. So later in the year our inflation forecast a little bit higher. By the fourth quarter we do have inflation running above 4%. So we think, given that the focus is very much on the headline target, maybe in the near term, given the certainty of forecast in the next 3 to 6 months, remember, who knows where inflation will be a year from now, and the standard errors around that are much larger. But given that we've got more visibility in the near term, maybe there is space for modest easing in the next quarter. I think
they've
what we're
also
building in is
given us new data in terms of
cut.
Okay. No, they've given us new data in terms of household expectations falling rather seminally by 130 basis points, and therefore
yes.
I'm asking you, will you lower your own forecast?
Yeah. No, we're going to, our forecasts are very similar in the first half of the year. We're holding on to our forecast in the second half of the year, given what we find between headline and core. I'll say on the inflation, this is positive, the household inflation expectations are coming down. I'll just say that they're very influenced by food or fuel. So these things do bounce around. If food prices move back up or fuel prices move back up, inflation expectations can easily go the other way.
Oh, you don't think that the fiscal pressures have been underestimated?
Well, I think it's a bit early to say, because as I've been saying, the center is a very small piece of the pie. So we need to look for what the full budget tells us in July, what the states are up to, and what the public sector is doing. If, like last year, we find that the public sector borrowing requirement is getting wider again this year, then that will have an impact on core and headline inflation down the line.
Fair enough. Well, Manish, I wanted to ask you, we have a new man at the helm, and he usually imparts his own tone to the MPC as the chair of the MPC. What would you notice as a new tone of the new governor to the MPC's statement?
Quite an interesting one, Lata. We were all awaiting for his official policy for the first time, and I think that he has left his mark today on what he has done. From that point of view, you can clearly see that he's going to give equal importance to growth and inflation, which is evident in the rate cut today, what he mentioned. On the other sides of fiscal part, what you were mentioning just now, I think we have to go by what he just mentioned, that we have taken into consideration whatever is there and we believe it to be so. I think beyond that, I would like to mention something here is the inflation projections. In our view, or in my view, this is the best what it can be achieved, and I would say it's quite an aggressive, projections what they have given for inflation for the second half. Nonetheless, because last 6 months have been such, and you could err on this side also, we would wait and watch, and I think I would allude to what Sajid said, that the second half could be a situation wherein, if the growth is so high, at 7.2 to 7.4, what is being mentioned, you could see inflation inching up a bit from here, what we have seen. Lata, I would like to add one more point here, which is very, very important takeaway from today's policy. Because you were asking Mr. Rangan quite a number of times regarding the cost of credit or cost of funds. I think what today's policy has done is that it has thawed, or it has given a thaw in terms of what credit markets have been going through in the last 3 to 6 months. We have been hearing all kind of negative news of 1 or 2 or 3. It gives some kind of space for the credit markets to start functioning at the short end at least, and that is so important today. I think that is the biggest key takeaway, a positive takeaway for the fixed income markets, because beyond focusing on the 10-year bond, that forms a very large part of our economy, and it is having a lot of impact in terms of pricing of loans and deposits, what we talk about. I think that is a very, very important development what we're seeing. It will help the credit markets to function a bit now more smoothly.
Okay, actually that was going to be my next question to you. Do you see more lending in the wholesale markets?
I think with liquidity being, as he said, as the DG said, liquidity being on the neutral side, etc., and with the further rate cut expectations, if I may say so, in the month of April. And you should also see one more development is the FPI 20% rule. That should actually, help some of the FPIs who've been sitting on the sidelines and not doing beyond that. So it could help companies which are on the AAA or a AA segment. So that is where I'm coming from. This is a good enabler for funds to flow towards credit. And I hope we will see the impact, positive impact in the next few months.
Okay, very quickly, Sajid, out of time, but what's the stamp of the new governor on the policy, on his maiden policy?
Well, I think that they're going to take the legislated inflation mandate very seriously, and monetary policy will be conditioned on, on the 4% target. I think they will continue to be data dependent. And number three, I think they still worry about growth. They believe that output gaps are negative now, and despite strong projections of growth, we're a little bit more sanguine that, the core inflation signals are there's perhaps not as much slack as some may expect or believe.
Okay, well, we'll leave it at that. It looks like some positive, takeaways for the borrower and for the investor. Manish and Sajid, thank you very much for joining me. It does look that the tone of the monetary policy and the new governor has given a little more space for growth and a little more impetus for growth, and therefore the credit markets, which were rather dislocated by negative news, could begin to see a bit of fillip in terms of lending. There is not much of a hope that the cost of money for NBFCs or for people who are borrowing from the wholesale market is going to fall much, but there does seem to be a little bit of a spring in the step, in the sense that there is an expectation of yet another rate cut. That's it on this special edition of Indianomics that concentrates on the key takeaways from the just announced RBI monetary policy. Thanks very much for watching.